Refresh. Test. Test. Okay, that sounds good. What's up, everyone? Happy Tuesday morning, 9 a.m. Doing the Twitch stream. We're going to be looking at a car wash model today. It's going to be an upgrade. I built this model quite a while ago. If you don't know, I've built, I don't even know, 80 or 90 industry specific models and a bunch of other types of models. So I'm at the point where I feel like going back and doing upgrades to earlier models that I've built just for added functionality. So every Tuesday morning, that's what I'm doing. Or if somebody comes in with a suggestion or something, um, I'll do that as well. Or whatever. This is a time when I'm essentially available for free to talk about whatever, and I'll be working on either upgrading models or new models as I go along here. Don't forget to subscribe if you're on YouTube, and let's get into this. So the car wash model, pretty straightforward. So let's just go through the tabs so you can get a run through of what it was, which basically you put in and it was for just a single line car wash or a single location. You put in your startup costs, the start date of the project, any financed amount, and you get your resulting equity required. Lead time, I think, must have went off the start month, yeah. So we're going to update all the timing assumptions and everything else. I'm going to add in options for investor funding. The biggest update, though, is going to be seasonality. So right now, so you had your startup costs, start date, you got your running costs, which I did based on a cost per car, variable cost per car. And I think I did this because when I was researching this type of business, a lot of the costs were denominated in, like a lot of the overhead was denominated in basically price per car. So for every car that goes through, 50 cents for electricity, 12 cents for natural gas, 16 cents for water. Then you've also got fixed costs per month, which I didn't do any. So we probably should update that too because I didn't do any granularity where you can change it over time. It's just the monthly costs, and that's what they are for the 5-year model. Revenue assumptions. So let's see. This is where the biggest upgrade is going to come from. So first of all, we've got over 6 years. Okay, so I'm gonna have to update the timing assumptions. This model actually was done before I started making them only 60-month period in total. So I know why I put 6 years here because if you start it halfway through January, it's gonna go to of 2020, it's gonna go through to halfway through 2025 rather than 2024. So that'll be an update. I did price per type of car wash, and then the percentage of cars that go to each type. That's good. This is where we're going to start to, this car count per month is where we're going to break out into seasonality because with car washes, a lot of times the cash flow is going to be higher in some months and lower in other months. And that's important for capital expenditure planning or just survival, especially in the first 1 or 2 years where it's really important um, to know when you're going to have cash. If you go to year maybe 4 or 5, when things are more established, it's not as important because you're getting the same amount of money in a year. It just depends on when. But if you don't have any capex things going on, or by then it's assumed that you've got enough operating capital that you're good to go. So the timing is less important. Also, you've got You've got the growth of cars, car count. So if you're in a great location, or you're just acquiring a car wash that's already existing, that um, it's not like you're growing like a startup where you start with like very little income and grow really fast. You're probably going to have a steady amount of traffic, and that might grow a little bit over time, but not a ton. If you're building a new car wash in a new area, it could take time for people to know you're there. So in that case, we also need to account for, um, we definitely need to be able to account for increased car counts over the years, which this will do. Financing tab is fine. Make this so you can do different payments per year. It's not really a big deal. So instead of 1 month, it's going to be, I think, 12 divided by this. And then if you do like 4 payments a year, 1, 2, 3, 4. Yep, perfect. Okay, and then the P&L. So this won't change much because really all we're changing is the car count, the seasonality of this. So what will change is, so we only need 1, 2, 3, 4, 5. Wait a second. Why? Why do we have so 60 months? So the model only goes 60 months. Why in the world do we have a sixth year here? Maybe I updated that portion of it, but I just kept the 6 year for no reason, I guess. Let's take this out. All right, so let's just start with the control tab or the startup costs. And actually, I'm going to rename this. Well, I guess this can just stay like it is startup cost. This is going to be the start date of project. And then this should always be the first day of the year operations will begin. So let's just say we're moving up to 2021, 2022. How about actually? So even if you're starting in August of 2022, you would still put 1/1/2022 because it just defines the year, not the month. So always go 1, 1, and then the year. And then this still is fine lead time, so this says essentially what year your operations actually begin in this year. So month 4 or 5, whatever it is. If we put it to like month 8, then this shouldn't start till August. Or, okay, so that includes the month. So you need lead time 8 months of time. So month 9 would be the start month in this case. So we'll just put that there to call it out. Just give me this, comma, this plus 1. Alrighty. So we also want to show if there's going to be investor money here or not. So you can put, and I'm going to do the whole cash contribution distribution tab, which doesn't even exist on this model. So we're going to say potentially if investment funding. And then now you'll go to remaining cash down here. And this is remaining owner funding required, which might be 0 if you get it all from the bank and or investors. So percentage share for investors. Let's say if you're going to get 80,000 from them, you're going to give them, let's say, 25%. This is going to go down. So you got, let's do funding sources. So we'll say we're funding this. Well, actually, this is going to be different. So startup costs are here, but we're also going to account for burn potentially, like if you're running a lower car count relative to your OPEX, and um, debt service, you might have some months where you are not profitable. Oh man, we're actually gonna have to put in, yeah, we're gonna have to separate this out because these shouldn't start until the operations start either. But if you have burn as well as startup costs, then those all that needs to be accounted for and how much cash you need. So we're gonna add that in. Let's see. So you got startup costs. This is actually going to be not percentage of startup costs, but percentage of total equity requirement in debt, I guess you could say. So we actually need to put in here total equity required for project. So this is going to be a number that we pull once we have all the other calculations in. Some percentage that's going to be financed, which goes to the financing tab if you put a percentage in here. Some of it you might have with investor funding, and that's going to be implied valuation. And then remaining amounts just a filler, which is going to be, once it's all done, it'll be this minus this minus this. All right. Also, we're going to make these all blue text. Just some formatting and change this to more of a lighter yellow. Oh, I guess that year 6 was, yeah, so this is just equaling startup costs. If I were to have put in like 5/5/2022, then it would end on 5 or 4 April of 2027, because it would go 60 months, and since we started halfway through. But now, this is always going to be the first month of the year of start, so I'll clean that up. So that's why we had 6 years in the assumptions. So this, there we go. So that'll be hard coded into that. What else? So this, well, there's just a lot of updates to the expenses. Let's just, all right, so I got the general structure. I'm gonna have to update a lot of stuff to get to here, but we can move on to the whole thing that we're doing here, which is, I don't know why in the world I put, I guess it's under sales. We're gonna move on to seasonality. So let's do, so average car count per month. We're actually gonna go, that's a bad title. Let's put our years up here, and this can actually also be the date. All right, so let's think about this. Average car count per month. We're probably just going to have to say average car count per year, or expected yearly car count. And then the seasonality should be the same in each year, because wherever you're putting the location, the seasons are not changing. And the reason why we're doing seasonality in this model is because oftentimes, if you're doing a car wash, people go to car washes like after winter or after a bad snow and salt, and then it gets sunny out and a little bit warmer, you'll see a big spike. So there's certain months that are probably going to be busier than others. So that's important for the cash flow part of this model, and we need to add that. All right, so this is going to be car count per year. So let's just say, whatever your projections are that. You could just put percentage growth in car count. Let's get a little more sophisticated with that. Let's say 20%. So then number will be this times 1 plus that. Now it probably won't grow from 36,000 to 1.2 million. Oh, even at 20% compounded growth, you're probably not. You might double. So that's probably that's a reasonable. All right, so we got increased car count. Now we need to put seasonality. It's actually very simple. We'll just do percentage of yearly volume in each month. So of these 36,000, one, 2, 3, 4, start here, 1, 2, 10, 11, 12. Month 1, now you're going to see we have to get clever in how we do this because on the monthly tab, if we don't start having revenue till some month in the future, but we have we need to know. Well, actually, since we're doing this annual growth of car count as a reference, I think we're good. And this obviously needs to be full 12 months. Even if like year one is going to be a half of a year, you need to still have a reference, and this is going to be divided by um, well, this is going to be multiplied by whatever percentages are put in here, and this needs to represent a full year. So this has to equal 100%. Here's your check. So let's say, 30% of the cars come in January and February. You do 10, 5, where are we at? 75. Let's say actually 20, 20. And we'll do uh, some helper calculations so you can see what this means. Oh, it's 100%. Wait, 105. Let's put maybe 15. So out of the whole year, 15% of sales are in January, 15 in Feb. We'll do 10 in March, 10 in April. What are we still off by? 90. Let's say maybe a little bit more in December. Okay. Now, theoretically, year one expected monthly car count, because you need to know if you're actually putting in a number that makes sense. So, like, if you expect this many cars per year, 15% in January, that's 5,400 cars in the month. The question now is that realistic? So you can adjust these percentages and the numbers up top here accordingly. And this should equal 36,000. So some of this equals this. And then we can actually go average car count per day assumes 30-day months. This is just to get a rough idea of the realistic nature of the numbers. So that's 180 cars a day in January. All right. So this is just like a sanity check slash helper to see if your assumptions are even reasonable for your volumes. 180 cars a day every day for a month seems high, but I don't really know. I mean, that'd be so 180 per day every day of the week. You do average car count per hour even. So if that's in a day, say you're open for, I don't know, 10 hours a day, just divided by 10, you're looking at 18 cars a day in that month. 18, 12, 6. So this I didn't actually feel like this made sense until I got down to here. So the car count per hour is really a good idea of, can you get 18 cars an hour? Is that even possible? 6 cars an hour definitely does seem possible but high. And this assumes, let's actually make this an assumption. So let's just say hours open per day. So if this were 12 hours instead of 10, that would mean you're probably going to have, you don't need as many. You got 15. And if we lowered our yearly expectation to say 30,000, decimals are completely fine. Okay. Oh, hours open per day. I guess we could put, this is kind of confusing actually. So I just don't want to take up too much space. So this is hours open per day, and then this line is average cars per hour. We probably want an assumption for days open per month as well, because you might not be open every single day. So let's do this here. Days open per month. Let's say maybe 26. And then, so 173, that's divided by 12. Okay, that's better. So I want to put these down here. Average cars per day. Now see, this is messy, but we have to have this in here somewhere. I guess that's fine. As long as it's there. I mean, it's clear. It's just kind of an extra 2 rows here. Put in a bottom border. So monthly car count. So this is what we're going to use. We'll use these percentages in all the calculations. Now, if you want to simulate, actually, let's go simulate year X. So let's say you wanted to look at year 2, because honestly, you're going to need to know if your growth rates are also reasonable. So we'll just make this equals this times index. We want to return this if the column matches this. Lock these, and D20 needs to be locked. Now that has to equal index this. Perfect. Okay, so like if I want to look at year 5 and say, well, if I grew at 20% and get my car count each year, what do things look like? So 30 cars an hour, 30, 20. And it really depends on you need to make sure the car wash capacity is able to do that. 10 an hour seems completely reasonable. 30 an hour, I mean, that would mean 30 cars per hour. I guess we could even go further down. We could say, based on that, what's the required maximum, required maximum average car wash time. So to get 30 cars an hour, each, so that's 60 minutes. So that's 2 minutes of car wash, right? Max. So this kind of gives you a nice sense of, like, really shows you, do the assumptions make sense? Is can the average car wash time be 2 minutes? If that's not reasonable, then your capacity, you don't have enough capacity to fill that assumption, so you're gonna have to adjust your car count. I'm just making sure. So if it's 2 minutes, you do 30 in an hour. Yep, that's 60 minutes. That makes sense. So these are all important things to think about when you're structuring how your car wash works, the timing of it, what your volumes are expected to be, and it all shows you how much money you might be able to make in the end. All right, so I think this is a huge upgrade to the model. Um, we're going to start this actually down to 20,000. And when you have a really high amount of minutes down here, you can see this is when you have potentially excess capacity. All right, so potential sale business, that's fine. We can still do this logic. Percentage of EBITDA. Oh wait, this actually has it so you can do either percentage of sales or EBITDA. That's fine. All right, so we have average car count per year. We have seasonality. Let's move to the monthly P&L and see what we fill in here. So C17 is that. So the exit month, if we're past the exit month, okay. So we're just assuming it's at the end of the 60-month period, which is fine. I don't really think that's a needed upgrade because if anybody's accounting for the sale of the business, they're likely running a 5-year model. Although even if you're not running accounting for a sale, you may want to stop operations earlier if you just want to do like a 3-year model. So let's add this in. Change the tab colors too real quick. So and really this should be, I usually have like a control tab that has all the sale stuff and start date and all that, and then the startup costs are usually on a different tab, but I don't know, people seem to, I haven't had any complaints, and this model has had quite a bit of sales over the years, so I think I'll just leave it like it is, just as far as that, the formatting of that. Exit date, if applicable. So this is going to be some month in the future there. And if you just put the last month of the forecast, it'll just go to the end and it it won't stop any of the operations. Okay, so our first big thing is going to be if this is greater than the X date, then 0. Otherwise, if this is less than the start month of operations, then 0. Otherwise, let me just put a 1 there for a second. Otherwise, we're going to do the actual calculation. Uh, start month of operations. And let's put a little bit of a softer line here. Oh, that kind of hurts my eyes. What's a good one? Perfect. Um, that's fine. Put our borders in here. Make it look nice and easy on the eyes. Alrighty. Let's get back to where were we? So that's gonna zero out everything. Just lock that and that. So otherwise, we want to do index, and we want to return the percentage based on if the month matches. So we're going to match the month of this date, E5, if that matches these, come 0. And then, so that's the percentage in that month times, and then we're going to have to do another index. And we want to return the yearly car count based on the year we're in. So match in the years in E2, comma, and that has to match the year here, 0. And then let's see, lock that, lock that, lock that, lock. And we have to do the locking because of the 12-month, the seasonality part of that. All right, let's see if we're accurate here. Drag this over. All right, October 2022. So month 10 is month 10 for year 1, 1,000. Yes, it is. Um, let's drag it over. And let's go. Okay, is month 12 of year 5, 4,147. Let's check it here. Yep, 4,147. Perfect. I also think it could be useful to. Okay, so these all are working great, so that's cool. You now have seasonality, which is going to play a bigger part in the first couple of years, where you can see your bigger cash flow months are going to be obviously the bigger volume months. I think that's a great upgrade we've done here. Why does this have an issue? Well, first of all, let's get rid of the H lookup. We'll do all this index match. So car count per month by type will just be indexing row 9. And match year. Index match is a lot better than H lookups for this kind of thing. Match year. And since our data is in order, we can just drag this down. I gotta lock this though. Oh shoot, what happened? Oh, I gotta multiply by the car count total for the month. Okay, so you can see the cars. Now what might be interesting, if I have time, I might do it, is adding the amount of time each type of car wash takes, because the higher end ones might take longer, and making sure on average your average time per car is not exceeding your expected capacity. Like if based on these volumes you have to have an average of 6 minutes a car, and your average is 10 minutes a car based on the time it takes to do each of these kinds of car washes, well, that's a problem. That means you're not going to be able to do your volume. You're going to have to reduce it. So I think we'll do that. I think I'll do that on a different tab. Um, but for now, you see the total car count per month. And if you want to test that more, you just go to the revenue assumption. Then you could test each year's car counts to get down to maximum car wash time per car and see if that makes sense. Even average cars per hour. This is another good one. Put that one in bold, actually. What I want to do is also put some metrics down at the bottom here that show like all of this stuff over time. And then we can measure that against the other stuff, the average time per car wash type. Okay, before we get into all of that, let's look at the variable expenses. I don't think we need any upgrades here. This is just doing, yeah, total cost times the car count for variable costs. Now the fixed expenses. Okay, so here's what we need to update. So number one, well, this is going to be the same starting logic as the car count here. So if it has to be earlier than the exit month and later than the start, or greater than or equal to the start month of operations. Otherwise, zero that out. And if it's not, then I'll just put a 1 here here for a second. Okay, so this is the other tricky part. Running costs. So we just did a fixed amount. Um, it's possible as you expand, you may have to increase some of these, or the cost just might be going up. So 1, 2, 3, 4, 5. I'm just going to give the option to change these each year if if you want to. If not, you can keep them the same, that's fine. Since these are variable, they just the variable cost will just change with the car count. Well, I guess you could account for some of these things rising in price that actually makes sense. So let's we could change that to by year. Let's format this a little bit nicer. You zoom in. I'm going. How do we do the other one? I just put a general title at the top. Okay, so that's fine. Ongoing costs. And then we've got what? Delete. Okay, so the cost names are changeable with the text. So that's clearly noted with the coloring. We don't need to call it out again. All right, and then here the prices of that can change. I might as well just move this over. All right, you've got your variable cost and your fixed cost. Now, so variable cost, let's get the index in here. So it's going to be car count times, and then we're going to go index this one, and then E2 should follow that. Lock this one, lock that. Actually, we just need 7. And don't lock that. Okay. Perfect. So that's the same. So that means it's correct. Perfect. And then if we were to raise, let's say this to $1, 13, 17. So now year 5 should be higher for the monthly cost than year 4, which it is. Yep. Yep. Well, 80. What do we change natural gas to? Oh, $13. Went 13 cents. Perfect. So we know the logic is pulling through there. That's good. So we've got our seasonality in. We've got proper assumptions for start and end year. Let's make sure the end year is working. If we put this to like November, yep, everything should stop. Now the fixed costs, we want to index this. E2, which is the year. That 0. Lock this and that. Okay, now what do we do? So 1200. So why is this not pulling through? D38. Oh, we need to lock this too. Drag this down and over, and there we go. Okay. And perfect. Now if we raise this, just do a couple. Okay, so that changed by the year. Perfect, perfect, good. So that's working fine. Just put this back to how it was. All right, so now you've got granularity in the variable and fixed costs in each of the years, so that can change. We've got seasonality and sanity check metrics, as well as just assumption checks to see if it makes sense. I've got it propagated through here. Now, that's good. Debt service is fine. Cash flow. Okay. So, now why did I do, I don't want to put a starting bank balance because we just want to look at the project. So, cumulative cash flow. So 80, what do we do here? So this is startup cost. Oh, hold on a second. I have to use the restroom and I can't really pause the stream. So let's see what's a cool screen to look at. I guess you guys can look at this one. Be right back. Okay, I'm back. Let's get back into it here. Am I still live? I guess we could check. Test. Test. Perfect. All right. Where were we? um. Okay. So let's get our EBITDA here. Format a little differently. And cash flow. Now, what in the world is going on here? Um, I have cash flow before tax, running cash flow, cumulative cash flow. What? Why did I do both of these? This is the same thing. Break even month 23, where you basically, that's saying the cash flow has now gone positive based on all the startup costs. All right. So, sale of building. So this has to happen only if this date equals this date. Otherwise, don't do anything. But now, so before it didn't have this, it just did it on the last, oh, otherwise 0. It was just doing it on the last month. But now that we have options to end early, we need, okay, what happened? Oh, all these were not locked because it wasn't made for moving to different months. All right, revenue, this. Lock, lock, clean this up. Okay, there we go. Put this all the way over here. All right, and make sure, yep, perfect, that accounts for that. Now, oh, and debt, so we have debt funding, debt repayment. Let's make this box a little bit further down and put these up. All right, so debt funding is going to be if this equals, what's this? then this. And we have to make sure. So now, could we change around a little bit how the assumptions drive things? So now this actually needs to be an input for the date. It'll usually just be like the first month of the forecast, but maybe not. So it's got that granularity if you need different month of financing. So that perfect. So that's that coming in, and then on the exit month, if there is one, now, okay, so the other part of this is if this equals the exit month here, then repay the remaining balance, which would be this. Okay, 203. So now if that's paid back, so if this is, first of all, if error, then just go to 0. And then a balance. But we also want to do if this is greater than the exit month, then also return 0. All right, let's make sure that works. Okay, so total principal was, let's just make sure. So if we sum up all of this, sum of this. So we did this, paid off this, should be 203, 525, perfect. That works, that's correct. So we pay that back, balance goes to 0. This is funding that happens here. Just put this back to the first month. Okay. Now we have some nice new logic. Cash required, debt funding. Now we need well, let's see. So now before any equity, before tax and equity, so this is going to pull right into here. Min of this. I don't know why I have two running cash flows either. I'm just going to use this one. I've got a circular reference, so we'll see what's going on there in a second. I don't need this. All right, that's that. No, okay, so this just needs to, what in the world was I thinking? This should be this plus this. What do we do here? Startup cost. Debt. Okay, so here's the first issue. This percentage of total equity required in debt. No, we're not doing that. We're doing total debt funding from bank. And we're just going to put in a number. Let's say 250,000. And the debt will then equal that. We still got a circular reference. Need that anymore. Come on. What do we got going on here? Cash flow, this is just this minus this plus this minus this minus this plus this. Okay, same numbers. This equals that. Ah, okay, so here, this needs to equal this up top now. There we go. All right. Now we go minimum. So it's saying you need 1 million in additional funding. 250,000 from a bank. Let's say investment, you get 500,000. Should be its own thing. Now, hold on a second. And that should be never below 0. So we're going to do max of this or 0. So you could zero out, let's say you don't want a bank loan, you can zero that out. It's 91.3. If you get this from the investor, you still need 835,000. Let's say you get 1 million from investors. Just doing some checks here, so 335, that makes sense. Okay. Perfect. And then that will always go to 0. Actually, so in this case, you're running at a deficit. Maybe a little bit more car count. I just want to see it get to positive. Okay, positive in month 59. Vacant lot site work. Now I've just put random numbers in here, so it could be high relative to what the car wash could do. And I guess there's no reason why this can't be a car wash with multiple bays. Like maybe you build a 3-bay car wash. It doesn't have to be just a single bay. All that really matters is we're assuming there's an initial cost here, initial cost per car count, some fixed overhead costs, and then your car counts. So technically, if you built like let's say 5 of these locations, you could put those costs up here, assuming they all start with the same in the same amount of time. Let's put the lead time down to like 3 here. And then you would just do your fixed costs accordingly to 5 locations instead of one, and you would do your volume of cars based on 5 instead of 1. So technically, you could use this for multiple locations as well, or just a bigger, like it doesn't have to be a single lane. There's no reason why it wouldn't with this logic. Uh, you just put the costs, startup costs, operations, expected car volume, percentage of cars of each type, and then you get obviously the new updates with seasonality, and you could see, yeah, so that'd be fine. So in that case, if you were doing that, you would have to look at this and say, okay, if I'm doing 12 cars an hour, if there's 3 locations, then you're technically doing 4 cars an hour per location, or however many. So that would just, you'd have to account for that when you're looking at this. I guess we can add that here just for the pure sake of number of locations. Let's say there were 3. You just divide this. So average cars per hour is 12, but you're doing it across 3 locations. So per location, this is going to be total car counts across all locations. So this, you can divide that by 3. And then, oh, that's already based on that. So if you're doing 48 per location, that's 4 cars an hour per location. So this doesn't need to be additionally divided. And then max car wash time, 20 minutes, 40 minutes. And if we go back to 1 location, everything goes back to how it was. 3, so 12 divided by 3, that should be 4. Okay. Okay. So now you don't have to manually do that math. I just put in a little more logic so you can just adjust the number of locations to get correct averages here. All right, perfect. All right, I like where this is going. This is really a great model. Turned it into something I think that's going to be a lot more granular, a lot better for sensitivity analysis and cash flow planning. Now, let's say, just for the sake of fun, let's just leave this at 1 location. 5 minutes. That seems like reasonable. Let's lower this a bit. Now what is this? Total equity. So it's saying you're basically starting right off the bat. So if you're remaining owner funding required, This should also not be negative, so we could do, that's just a surplus. This will always be a max of this or 0 as well. But let's say now your investors, you only need 500,000. Owners come up with that. So again, you can always adjust these if you don't have investors, this can always be 0, or if you have all the money from investors, then this should equal whatever your equity requirement is. We wanted to do those calculations, so we obviously have this. So we want these three. I think these three are kind of cool. So 1, 2. Also, I want to make sure this goes to 0. No. So that won't. But if we do a cash position on, so hold on, equity funding. So we get money from investors and owners. Oops, that's 29. This all happens in year 0. Now you actually, so here, okay, so I guess it'd be year 0 is 0 because you're not having any burn. And then, yeah, you just do this plus cash flow. Now, let's see, let me think about this. Let's say, where are we in May? Let's say May's a low month. So let's say only 2% of your yearly sales come into May and June and July. And let's see, what is this off by? 1 minus some. So you can see this will make this easier. Oh, what the heck? 9%. So we add 9%. Let's say we add 5 to this, 4 to this. So these are your lower, really low months. So if we put that into here, now we should have a burn. Perfect. Okay, so now you can see this gets to 0 here. Good, that makes sense. Now you need a little bit more than your startup costs because there's some burn, so you need cash to cover that. All right, good to go. I just have to do all these checks to make sure whatever your situation is, the math will not have an error or it's structured right. All right, and we're gonna do charts on this too. So average cars per day. Wow, actually, I didn't have any visuals on this model, so I'm gonna add a bunch of those too. All right, how did we do this? This was average cars per day per location. So total, you do the total car count here divided by working days for the month, and then I guess divided by the number of locations. And then average cars per hour is this divided by working hours in the day, which was that, or hours open in the day. And then max, okay, and that's fine. So now we get this nice running thing. So these numbers should match 19, 1, 6, 37, 19, right? Because we started May 96, 8, 7, 5 should be month 12. 96, 8, 7, 5. Oh, yeah, perfect. Okay. So average max car wash 18 minutes or 8, 1.8, 1.9. At least this is actually going to be a cool chart. Essentially, it shows you how close you're getting to your maximum capacity that you think is reasonable. Now, before we get any further, the 5-year. So this, it's honestly, since we don't even have visuals or anything else attached to this, I'm going to delete that. Oh, we do have visuals here. Okay, that's good to know. So I can update this return tab. Let's copy the 5-year monthly. And this is now 5-year annual P&L. 1, 2, 3, 4, 5. I just don't want to reformat the old annual tab. It's easier just to do the monthly tab and just cut it down. See, quarters don't make sense. This doesn't matter. This is year number. All right, car counts. So now we just do a simple sum ifs on all these rows. Sum ifs this row if the year matches our year. Lock it. Lock that. And then car count by type, we just bring that down, unformat it. Line style, put it back to that. All right. 166, 166. Now this should already be the same because it's just taking the count times the number, but we'll just sum it up anyway that way. Variable costs. Oh, what's circular reference? Or it might have been from the old. Oh, here. Wait, what? Oh, this was the old annual. Okay, so this equals that. What is this equaling? Yeah. Okay, perfect. Fixed expenses. Um, EBITDA, debt service coverage. That'll pop in with this. Wait, what? What happened? Some 60. Why is it? Oh, because we had no financing. Let's put some numbers in here just so we can make sure it looks right. Some debt. Now, obviously, debt makes your cash requirement up front less, but you get less back because you have to pay interest. Okay, there we go. Balance. So the balance should be looking up this, the last day of this year, which would always be E-date, this, comma, 11. And if it sold early, it'd be less actually. So we want to do this balance actually should be the financed amount minus any principal paid. So it should be the same for each year. Oh, oh, apparently not. Okay, I don't know what that was doing, but okay, 75,000 after 5 years. Perfect. Um, Debt funding. So this actually, so here we got to make sure we don't mess this up. So this equals this, and then you can do the summus for the rest of that row. And this one. That's fine. This is just summing up that. All right, cash position. So we should be at, is the break even year still 5? I guess month 49. Let's put this up a bit. Okay, that's year 4. Um, and again, the assumptions are really arbitrary. It's just depending on what you are putting in for your situation, what you think is reasonable for whatever you're doing. So 1,951,318, 1,951,318, and this one's 1,083,732. Okay, so that all looks good. We've hit everything. So let's go to return summary. Cash invested would equal, let's do, that's actually going to be as a project level, this and this. Total years count if I guess we could do count if the months are less than or equal to the end date divided by 12. So this is now a calculation. then this would be this. IRR, simply go to the annual and do it. Let's see, this is the money before equity. So you put in 845, and then the project returns that before taxes. Break even year. This. Oh, I think that was already there. Total return. So delete all these notes. So total return is going to be sum of, well, let's think, how do we want to do this? So now we need to start doing the cash distribution, and so we're not going to need these fields because they're going to be in the other one in a better format, but we can keep these top ones. This is fine. So one thing I did want to do before we get into this is make sure, let's say you don't want to exit, so you just want it to see what happens if just operations continue on. Okay, so yeah, we can't do that. All right, so what we have to do is put an NA here. This should not be removed. And what it will do is allow this to be NA. So this needs to go over to BM. So now if you put NA, there we go. So things just keep going in, but there's no exit. So you're not paying back any of the debt balance, but you're also not getting any, you're not selling anything. And this is sale of business, not building. And the sale to business probably would include the building itself, but that's all just wrapped into the multiple. Okay, so we can keep the return summary here, but what I want to do is add some other summaries that we've got in the newer models. So let's see, select data. So what are we doing here? So that's still fine. Running cash position. And you can see the seasonality, you got the little up and down within the year. That's kind of cool. Revenue, expenses, and profit. Well, so that would be revenue. We'll have to change these to annual. Expenses. $95, yeah. And then profit. We'll just do EBITDA. Oh, I need the annual. 125. Get the year in there. Okay, and what the heck? What happened? Format access, axes. What do we do here? So years, one. Why is it just showing 2022 is my question. What the heck? Got all the years in there. E, did he start at E? Yeah. Where's the rest of it? Format this to the bottom. So what is this pulling? 309,000. It's pulling, for some reason, only year 3. Oh, there we go. Just hit a reset. So I don't know why this has to be in months, even though it's years, but whatever. Um, that works. All right, now the fun stuff. Car wash by count. So remove all this stuff. So we can do this. Low, basic, mid, mid high. Oh wait, did I miss one? Mid low, mid high. I missed mid. And high end. Should be 1, 2, 3, 4, 5, 6. And then we'll put, this needs to go down. Mid low, mid high, high end. And apparently, I don't know why this is doing it, but this needs to be formatted in reset. Make these a little bit wider. Profit margin. Where's that at in here? Did I even put that in here? Oh yeah, right there. Format, reset. Debt service coverage. Okay, so now we got all our old charts back to how they were. Those are fine. I want to add, man, we got a lot of work to do. So let me get the other, where's the last model? I think it was the Gym Fitness Center I upgraded. So we actually, okay, where's distributions? So this needs to all be added to here. But this actually doesn't have everything I want. Let's see, I know which one I know definitely has it. Let's do product as a service. Just looking for the executive summary format. Ah, here we go. So we'll only have one of those. That's fine. Yeah, I want all this. B2. So we'll have this and this. Well, this is going to be really cool when it's all done. Can't wait. And I'm not raising the price on it at all. It's going to be still $45 for this when it's all done. All right, so now all we got to do is remove all the references. So this is executive summary. This is distributions. Usually these actually go up front. All right, so we don't need these two. Let's just do revenue is right here. Oh, and we got to add that thing for the time of the average time per car count. Hold on, let's do that before I forget. Total revenue. Revenue variable. Okay. Before I forget, we want to define average time per car wash type. And this is important for checking if you have set up your assumptions in a way that makes sense. So we'll say low. How are we going to do this actually? 3. What do we get down to? Max car wash time in minutes, right? This is minutes. Yeah, because that's the amount of cars per hour. So 17 cars an hour. Each car can take 3 minutes. 3.3 minutes. So if you do 60 divided by this, 60 minutes an hour. Every car takes 3.3 minutes. You can do 17 cars an hour. Okay, good. Just want to really make sure that's accurate. So this is in minutes. We're going to say, let's say this is, and you can do decimals here. Oh, what the heck was that? We don't need that. 2. Let's just say 3, 4, 5, 6, 7, 2.5. And again, these are arbitrary, but I think it's important to have these. So now, if we do our check here on the monthly, we can see if we have this many cars on low in a month and they take this long, J9, 1, 2, 3, 4, 5, 6. Oh, gotta lock that. This should give us the average minutes per month. So okay. So then we do, so this is the total minutes per month. This is car count. Then we divide that by, so we take this divided by days in the month on average that you're open. That would give you, uh, make sure, is this 6? 6, 1, 2, 3, 4, 5, 6. Yep. All right. So 6. One second. So what's that equal? 3, so this many minutes per, so hold on, this is total minutes in a month per car type. So 168 cars times 2, so that many minutes in a month. Now, is that 12 minutes a day? What am I missing? 12 minutes. See, this stuff's where you gotta really check. So let's do it hours, minutes to hours. So 336 minutes worth of time divided by 60. So 5 total hours a month is your actual. And for that one, so it's 5. Just trying to do, so if this is 5.6 hours, what am I, what numbers am I trying to get to here? We got cars per day. So this is based on like the maximum that the average car wash can take, assuming the amount of hours you're open and stuff. This is going to then say, well, if this is the time each car wash takes, then your assumptions are resulting in what? What do we want? I guess a certain cars per hour. Can we get down to cars per hour? Um, or how many minutes per car? No, average minutes per car is what we want to get down to. So if there's 336 cars in a month, or 336 minutes for this, so 1,652 minutes worth of time in total, divided by the total cars. Here we go. So we've spent that many minutes, and if you divide that by the total cars, On average, each car took 2.95 minutes. And, right? I think that's right. On average. Because you do the total minutes in the month divided by the total cars in the month, right? So total minutes was 652 minutes, and you had 560. So on average, that's 2. And so this number just has to be less than the maximum, and you're good to go. Because it's saying based on how long each of these takes and the amount of cars you have in each kind, how many total minutes are you taking up in a month per car type, and then just divide that by the total cars to get the average minutes per car. So then if we go here and do 2.95 times the total car count, we got 652 minutes worth of car wash time. Now I imagine that's going to change after year 1 because, well, I guess it doesn't unless we change the percentages. So let's say so this is year 2. Let's say you have a little bit less people doing this, a little bit more people doing that. It's a basic, and then maybe a little bit less people doing that, and a little bit more people doing the mid-high. So now year 2 should be a higher average minutes per wash. And that average makes sense. Honestly, you should be able to find the same number by going to sum product of this divided by that. Wait, what? Sum product. So I forgot the T. Wait, what? Sum product. What is the problem? Oh, oops, because I merged, so this has got to be J to J. 2.95. And then you would just divide this by the sum of what your unit or your thing is, which is just this always equals 1. So actually we can do a quick thing here. Let's lock E. And you can actually see your average rate here. 1. Whoops, what did we lock? We needed to lock J. Lock J. Unlock this. So there you go, and see that year 2 I updated, so it's 3-minute average of 3 minutes. Now if we raise this, let's say this took, 5.2 car washes took a little bit longer, your averages all go up based on the percentage of cars in each one. So we can actually put this rate down here and just say average minutes per car. And this is just a calculation based on, essentially it's driven based on this. Whatever you're putting here for average time each car wash type takes. And so what you got to make sure is these numbers here, the average minute count doesn't exceed your available capacity, which is essentially limited to how many cars you think you're doing in a month. So here in month one of year one, we're doing 5,600 cars. That's 215 cars a day. That's average of 17 cars per hour and a car every 3.3 minutes. So here you're saying you could actually do a car every 3.3 minutes. You're doing a car every 3.3 minutes, but and based on the different car types, the different car washes that different time it takes to do each one, you're actually taking 5 minutes. So right now, so here's a problem, or here's how the logic will tell you there's a problem. It's now saying, look, your average minutes per car is greater than your maximum average car wash time in minutes. So you can't fit 5,600 cars in a month if, based on how long it takes to do these car washes, you can't fit 5,600 because it takes 5 minutes per car on average to do all of these. But you're saying you can do it in 3 here. So you'd have to so, and based on these numbers, this is too high, so this has to come down maybe 26,000. No, it's actually going to come down a lot. Still barely enough, maybe 18. Now, if you added a location, let's say we add a second location, now it's gone up because now you basically have two. Now the car counts are going through two different places, so you can do the average time can be up to 10 minutes. Here it's only 5, so you're actually about 50%. You actually are forecasting 50% of your maximum, assuming you fill up every hour of the day. Okay, this is really, really cool. This is really cool. I like this a lot. Let's put this. I'll just put that at 25. That's fine. Let's get back to our thing here. So 5.38 should match what we had over here. 5. Yeah, this is just going to one decimal. Let's put this to one decimal. Okay. These don't need to be decimal. Um, and so now we can do some cool charts with that. So this is average minutes per car wash. So there's a big difference between average minutes per car wash and maximum average car wash time, which is here. Now, hold on a second. Why is this 74 minutes? What did I miss here? So this is saying 10. So it's just essentially saying you're way under capacity. Your maximum car wash time can be 75 minutes or only 5. So you're utilizing, based on the assumptions, about 5 of 75, which is percentage of max capacity utilized. And max capacity just means the amount of hours you're open per day. Actually, what should we call this? This is the maximum average car wash time based on the assigned um, car count. So based on the car count, okay, assuming you're okay, so yes, that is max capacity. So this is like 100% uptime would mean 100% uptime would mean you're doing a car every 5 minutes, right? I think average minutes per car wash. No, this is the actual. Um, Man, why is this so complicated? Maximum average car wash time. So this is saying, assuming you do your expected thing, you only are taking 74 minutes, or you're able to take a car every 74 minutes. So you're not really utilizing. Obviously, you're doing one car every hour and whatever. This is saying this is saying the actual assumptions that were input and the actual time it takes. You're doing a car every 5 minutes. Did I? Why is that so high at maximum average car washing minutes? Okay, I know what happened. All right, so when I did this, I think it's the location issue. So average cars per hour per location, D29. I don't, so 10.8, and we're at, oh wait, yeah, maximum average car wash time 75 minutes. So this is really saying you're only doing a car, you've only got 500 cars planned. So if you take up the entire day's worth of time, each car wash has to take 75 minutes. But each car wash is only taking 5 minutes. So there's some math here that says, how far, well, average max. So this is saying, let's say I took 5 minutes a car, 500 cars. So I took 2,600 minutes, and the actual minutes available, here we go. Available operating minutes. Actual usage of operating. Actual minutes used. Okay, and now for available operating minutes, it's just the um, let's see, how would that work? If you have, let's see, how would we do that? How many minutes can each car take if you use up the whole time? Well, if you're open 12 hours a day times 26, there's 312 hours in of working hours available, and then you times that by 60, there's that many minutes. Okay, so maximum capacity is this number. And that never changes because that's just based on how many hours you're open in a month or a day times days and open in a month. Now, technically, if you're open for 2 locations, then you could do this times 2. So we got to add that in there. Times number of locations. So max capacity is 37,000 minutes. How many minutes have we used is going to be this number. Right? Because that's the minutes each car takes times the number of car count. So, and you can see sometimes we're getting higher up here. So it just, okay. So percentage of max capacity utilized. And capacity is just measured by the amount of locations times how long they're open each day for the month. So this divided by this. So you're only using 7%, 18, 87. So what you have to do is you can't be over 100%. If you're over 100%, like here in this month, this doesn't make sense. So these 2 months here, you're actually saying, based on the time it takes each car wash and the cars you think, um, you would need 55 minutes, but you only have 55,000 minutes, but you only have 37,000 available. So, and you can see exactly how that ratio works. Look at average minutes per car wash, 5, maximum 3.6. So if this is over this, it's an error. And I wonder if this is the same percentage. Let me do, is this divided by this the same percent? Oh, it is. Okay, cool. I thought that was sure, but I wasn't sure. Um, so there's an issue there, obviously. You don't have enough capacity to do these assumptions. You're going to have to, in what year is that? So you'd have to go in here, look at, okay, and I'm going to do a highlight here, conditional formatting, highlight anything greater than 1. So year 3, January, year 4, Jan and Feb, Jan and Feb. So based on these assumptions, Jan and Feb are too much. If you go in year 3, we can actually do this. So because we know this, we can put a percent here. We can go percentage of max capacity used. Now in theory, this is always the same. Wait, no. In theory, for a given month, it's always going to equal 26 times days times hours per day times 60 times this is your 37,000. And then how much are you using? Let's see. So this and this are the same. This 5.2. Hold on, what was the ratio? It was max average actual average divided by max, right? Yeah, I think. Yeah, so actual average divided by max. So your actual average is this divided by the maximum. of this. Now, hold on a second. Now, why is this actually greater than 100%? Oh, yeah, because year 3 we're above it. If you go to year 1, it's all below. Now, why is this all 0? I thought I locked that. Did I lock the wrong thing? 26, yeah, I did. All right, there we go. Now if we go to 3, right. So we're only over in January. Year 4, you're over Jan Feb. Year 5, Jan Feb. Okay. Okay, good, good, good. So that matches. These percentages are identical to um, your monthly 72, 68. And actually, we haven't even started till May. So 7, 7, 7, 18. So May 7, 7, 7, 18, 18, 30. Perfect. So now any month, if this is greater than 1, it's an issue. So you can fix that right here. Go to month 2. Okay, so I would go to year 1. Year 1 is good. Year 2 is good. 3, issue. Year 3, there's actually more cars in this car count than are available. So either you have to change, you have to lower this. Let's say this is on a 15, but now you got to add that back somewhere. And what would make sense is you have to lower your car counts in that year to match so that it doesn't go over. So now if we go to 4, this is still over. Let's put this back on a 15 maybe, and then maybe put this to 4, 4, and then 5. I see this is still up, so maybe come down. Or you could lower this down. Let's say maybe we have less cars. There you go. We do 1 decimal on these percentages. All right, so that's awesome. That is really cool. That's really cool, I think. We got this percentage capacity utilized. I don't think the annual needs this. It's really just on a monthly basis, so we don't need to know the average per year. I want to do visuals. Just a general visuals tab. And let's do some charts on this stuff. So we'll have some visuals here for the revenue. I just want to do the. All right, so let's put, what's the 1 ratio? This. So this is going to be another cool chart. So that, and then that's the max capacity. Here's the actual minutes used. And we can also denominate it. Oh, first of all, this has got to be a line chart. So max so the average minutes. So if the red is above the blue, it means you haven't. So average minutes per car wash, actual versus available capacity. So on the high months, it's saying, let's make sure this is making sense. On a high month, you've got 5. Hold on, if this is 5, where is it? 5. Where's the 80 at though? Let's make this every 1 month. Still doesn't show it. Right? Because 5.4. Okay, let's do the other one real quick. So this is 1. This is the ratio is the same, but the numbers are different here. So this is going to be minutes, minute capacity usage versus availability. So now we do these two. So available is this, which is the same. It'll be a straight line. That's the max each month. And then here is what you actually did, or your assumptions of what you're going to do. Oops. This is that. And put in the year or the month. Okay. Now hold on. Now what? Why is did I label them wrong? Hold on. Available minutes, use minutes. Available minutes is that right? And use minutes. So your usage. What the heck? Okay, I'm really confused by this chart because actual 34,000 is less than 40. What is it doing here? It's completely just backwards. That's probably why this looks weird too. Um, yeah, 96,000 is less than 40. That should be down here. What in the world? What is going on with you, Excel? Oh, shoot. I see. My fault. My fault. This should be the first one. So average minutes per car, maximum. So obviously your average can't be above the maximum, and it gets the closest right there when you get the high months in January, and that's where your max. So the lower the number, the more cars you're doing. So this is when it really gets close, where your the average possible is almost more than the average of the assumption. And then the really high months are the slower ones where this is saying, okay, the assumptions are saying um, you're only going one car every 74 minutes. You could potentially go one car every 5 minutes. So there, that makes good sense. And as this goes down, this is going down because why? We're doing more and more cars. That's why, based on the assumptions. So you're still way above this. It gets close here in the 5th year. Um, but this is good. These big gaps here show you how far you are from hitting the maximum with your actual assumptions. And as your car counts go higher, you're getting closer to the max, but not hitting it. And then this, average minutes per car, wash, actual assumptions versus available. So max average car wash time, average minutes. I think I want to change the title of that to this is actual expected minutes per car. Yeah, that makes a lot more sense. So this is actual expected minutes per car. And then this is you can't get any lower than this based on the assumptions. Or if you're lower than that, then you've essentially said that um, you can wash cars faster than you said you could up here, which will give you a red thing on your percentages. Man, I think that logic is really, really cool and helpful. I feel like it really allows you to like show what's reasonable and based on the car wash count, or I mean locations and availability. All right, let's go back down to one location. And you can see we're even let's on 20,000, and let's put these down or up or down for. So you can see what drives potential volume is how long do your car washes take on average? How long are you open for? How many locations are there? Let's see, 2, 3. Oh, still in year 3, not enough. Now, obviously, if you're expanding locations, then you'll have more capacity, but it's going to take more startup costs to have more locations. So that's what this model is designed to do, is figure out based on your OpEx, the startup costs, investment, your potential volume, what you're charging per car wash, the amount of cars you think will do each one, how much long it takes. All that's taken into account to give you a nice summary of what's going on. Man, this is awesome. This is really awesome. Okay, our visuals are good. What other visuals did we not put on here? Yeah, so this is saying, well, based on all your assumptions, you're going to have to charge more money. Let's just say you're charging like 15, 20, 25. And maybe this is like a car wash service that's like super good. Um, again, I just don't feel like going through all the assumptions to put in numbers that I think are, it just takes research. You have to figure out in your area what you can charge, what type of car washes are you actually doing, and all this stuff, and what it costs to run it. That's all stuff that has to be researched. The models just allows you to see the math and what you're trying to assume. All right. Why does this say 0.2? Monthly 5. Oh, okay. So if this equals NA, then it's automatically 5 years. And then you just do this times 12. Um, anyway, what was I doing? Visuals. Oh, what did I not have? So this is cash flow, revenue. I want to change this. Kind of like that. Maybe make it a little bit wider. Uh, okay, so we got most of the stuff. Let's do this. All right, so cost of goods sold, we don't have any. So we don't have any of this. We just have, we'll do variable costs, fixed costs. So variable is here. Fixed is here. None of this. Total expenses, this plus that. This is all fine and dandy. Delete all this. We're not having CapEx as a row, a specific row. Debt service is this. Oh, oops, no, it's that. Total debt service. Total debt. Um, investor funding, is that company funding or owner operator this, startup costs that, loan proceeds this, and let's separate this into its own row or apart from the other ones. Um, debt service proceeds from exit, loan proceeds. Actually, we can just reference this. Loan payback. If applicable, taxes we're not doing before. Just take out the reference errors here. We're getting there, guys. We are getting there. Just summarizing now. Cash position. This would be this here. I believe 1,580,000. Yep, 434. Perfect. And then let's make sure our EBITDA matches everywhere. So 1.620. This should be bold. 1620. Monthly, I'm sure that matches because, yeah, 1620. Uh, this I can't do until we do the distributions. So now, okay, widen this out a little bit. Oh, nice. And I did a cash source summary here. That's kind of cool. All right, let's do this first. So we're summing ifs. Sum if the cash flow all the way at the bottom. Right here before equity is if this is greater than 0. And it's only 5 years, so we don't need 6 through 10. Oh, whoops. I forgot to also add if only sum if the year matches, obviously, to welcome to financial modeling if you want to know what it's like to do this for a living. By the way, this is it right here. 2022. Okay. Greater than 0. This is going to be less than 0. Now let's just put in our equity. So remaining equity to use, I believe, is the cash flow plus this. And then contributions is investment funding plus not debt plus owner equity. Okay, this just equals this. Where was I? Okay, then that should be fine. Now what this means is you just have some negative months in the future, even though you've already got your min cash position in, so it'll just come from some of the cash returns for that month or that year and net out. Make sure this is right. Let's just sum this 726 to 76, which should equal this. Perfect. And then the total cash actually returned is this number, 1,580,000, which equals perfect cash position after equity. So 1,580,000 is essentially saying um, you put this much up front, so you had this much cash, and then you had this much return. So if you total it all, your cash position at the end is this number. All right, I didn't say that right. So this 1,580,434 is the total cash returned, and that equals the total equity funding less what cash went out at the beginning, like the startup costs less which is just a startup cost less the debt funding, plus any operating cash flow, positive cash flow, or positive cash flow in general here. And you can see the difference. If you just do the positive, the amount for each year is 1,571,000, but you get to 1,580,000. The difference is you had some equity left over here after you applied the equity to your startup costs. And what that is going to cover is some of this burn in the first year. And then once that's all covered, um, any other future burn is just net against the positive cash flows to get your actual distribution. So that all looks good, all looks correct. IRR here for the project is kind of cash flow analysis. Then you've got the investor's share based on their percentage, which this is actually referenced here. That's there. Funding from investors, that's already referenced here. So that's good. This is good. Just making sure there's no references to the other workbook. Okay, this looks great. And you can see the IRR is always between the investor and owner. The IRR of the project is always going to be in between those. Now here it's saying the investors actually didn't get enough. They need more share to make it worth it for them. So let's say they get half. Now they at least have a positive internal rate of return. Project didn't change. All I did was change how much money is coming from investors versus owners. Now Let's change this data. So investor cash flow is going to be this right there. Owner cash flow is going to be this. And the years are going to be this. So there you go. Zoom out a little bit on this. There we go. And yeah, it's 50-50. Let's say the investors get a little bit more. Let's say they get 65. Now, if you just want to make it completely pari passu, you would give the investors exactly the share of what they invested versus the total equity required. And then it's just everything would be the exact same. For example, um, if this share equals this divided by this, now you can see it's the same, 19, 19. It's all the same. But it's not always like that because sometimes the investors get a greater share because they're putting up more money, and the operators will probably have a higher internal rate of return because they're not putting up as much money, but they're running the business. So there's offsets there that you figure out if you do a deal like that. There's also, if you wanted to do other distribution models, I've got joint venture stuff for, I've got preferred equity, two different preferred equity models, preferred return. So there's other ways in to split cash flows. As long as you have the cash required and cash distributed, you can put it into like any waterfall you want. I just did a basic one here that just gives the investor a predefined percentage and then the rest goes to the owner. If you don't have investors or just want one group, you just zero out, investment funding and just, this is the investment from whatever entity gives it. And then on the distributions, you can see there would just be, the project cash flow is the same as this cash flow. And, oh, and you'd have to zero out this percentage if you zeroed that out. There you have 19, 19. We can give this a decimal too. Give it one decimal, one decimal. Okay. Put this back to whatever 450. So we did, so next let's do this. So project IRR is that. Equity required is this. Projected cash return, I think I just sum this. Equity multiple, yep, okay. And now we do the same thing for the investor. So investor, internal rate of return is that. Their capital was this. Their return is this. And then you can see equity multiple and investor ROI as well. Now the owner, 17, they get this much back. Oh, whoops. They get this much back. This is this. Okay. All right. Well, I think that's everything, and this is a giant upgrade for this model. No increase in price. Um, really cool seasonality. We've got utilization percentages that are awesome that basically tell you if your assumptions here are realistic. It has conditional formatting. If it's not, you can test each year out here. You can actually account for multiple locations those locations will be assumed to start right at the beginning, and the cost therein. Yeah, I think it's definitely a more complete model now, and you've got some nice added tools to help the model give more insight. Also, we did some charts. I think this is probably one of the coolest charts I've ever done as far as essentially seasonality usage against capacity available. Really cool. So that's all I got for you. If you want to purchase this, it will be a $45 one-time fee. The model will be, you could just search on my site for car wash, or it's under industry specific financial models down towards the bottom. It's one of the first ones I did. Yeah, right down here. Um, car wash. And you just purchase it. I send the templates as soon as I see the purchase. Um, and that's all I got for you in general. Just note I do have a bunch of different models. I do bulk discounts as well for different categories of models if you want to do that, or just bulk orders of different types of mid-level, intermediate, upper tier, ultra, or everything. So I'm really happy with the model upgrade. I'll see you guys on the next one.